Leverage buyout analysis overview. A leverage buyout is where a financial sponsor or private equity firm puts in their own equity and takes on debt to buy a firm. The equity portion is usually much lower than the debt. For example, a company could be bought with 20% equity and 80% debt. The riskier the deal, the more equity would be required. This is because banks, where a lot of the debt comes from, would not want to risk as much of their own capital in the form of debt. For example, 50% equity may be required for riskier assets, along with higher interest rates. The reason for doing this is to free up equity so that it can be used for other investments, increase returns by using leverage, and limiting your downside by limiting your total equity contribution. The best example for a leverage buyout analysis would be buying a house. Imagine putting in 20% down and taking out 80% debt to buy a property that you will otherwise not be able to pay for. When it comes to making money in a leverage buyout transaction, the way you make money is to increase your equity value, which not necessarily means increasing your enterprise value. This is done in 3 ways. 1. Generating more cash flow or EBITDA as a proxy for cash flow. 2. Debt paydown. And 3. Multiple expansion. How to make money through an LBO. Generate more EBITDA or cash flow. This method should be quite intuitive. As the company generates more money, or a proxy for more money using EBITDA, the company should be worth more. Debt paydown. As the company generates cash, that cash can be used to pay down debt, thereby increasing the equity value and the equity portion of the total enterprise value. Multiple expansion. Multiple expansion refers to how much someone is willing to pay for a business. Assuming nothing changes for a business, it's possible that the overall market is willing to pay more for a particular business. The opposite is also true in multiple contraction. Economic cycles can dictate as multiples expand and contract, valuing a company more or less, even though the company generates the same cash flow. Like, comment, and subscribe for more content. Also, visit our website at www.wallstreetsmart.com for additional resources.